Howdy, boys and girls. Welcome to the Liberty Call for Tuesday, March 15th, 2022. It is the Ides of March. Et tu, Brute? A little Shakespeare there for you. All right. So hope everyone's having a great day out there. It is, a beautiful day here in Colorado, not a cloud in the sky. It's almost 70 degrees. What is the temperature right now? Oh, I'm sorry. Where I'm at, it's 56. I had to run an errand, so that's why I'm about an hour late today. But in town, it was pushing near 70 degrees on the car thermostat. So exciting times. So, all right. Well, kind of a good day in the markets. If you're, solely looking at equities, they looked really good today. Oil, gas, and other commodities, not so good. They took a big step back, but that's to be expected. They did take a big jump over last week. So. But let's go ahead and jump in and take a look and see how the indexes did today. Ooh, a little too large there. All right. Dow Jones was up 1.82%, closing at 33,544. S&P 500 up 2.14%, closing at 4262. NASDAQ up 2.92%. That's probably some good news for tech people who've been taking a beating. Closed at 12,948. Small caps are also up at 1.42%. The VIX was down 6.11%, closing at 2983. It was kind of going back and forth on the chart, just under 30 and then back over 30. So I had a couple of alerts on my through my email all day long because it just kept going back and forth. Canadian market was flat. Brazil down slightly. Spain up slightly. Looks like Western Europe pretty flat. Germany was down 0.09. The UK down 0.25%. France down 0.23. Eurozone down 0.08. Then we get into some other European smaller markets. They were pretty flat too, to the positive. This is Netherlands, Spain, Italy, and Switzerland. And we get into the Asian markets. Russia's market's still closed. No shock there. Most of the Asian markets took a beating. Looks like the Chinese markets, Shanghai was down negative 4.95. The SZSE component down 4.36. The China A50 down 4.87. The DJ Shanghai down 5.07. The Hang Seng down 5.72. So, and I did see some articles that some of the Chinese markets were just taking a beating today. So I'll have to do a little reading to see what that was all about. So, but all in all, other than the Asian markets, which got pummeled, looks like Eastern and Western Europe were pretty flat. And then here in the US, we had a pretty decent day. So, all in all, not too bad. Let's take a quick look over here at the commodities market. Crude WTI is down $7 today, down 7% to 95.13. Brent oil basically flat. It was up 0.15%, closed at 98.57. Natural gas was down 0.9%. Gold down 2%. Silver down 0.8%. Gold is down below $2,000 an ounce at $19.19. Silver's at $25.095 per ounce. So yeah, those took a little bit of a beating the last couple of days. We'll see what happens with the Federal Reserve tomorrow. I know a lot of people are probably sitting on their hands, just waiting to see what's going to happen with the Fed. Will they do a 0.5% rate hike, or they do what most people expect and do 0.25%? I personally would like to see a 0.5%, personally, but again, I'm not being pulled in different directions by corporate leaders and government leaders to try and keep things from getting too out of whack. If it was me, I'd raise interest rates up to 4, 5, 6%. Let's put a squash to this, get it over with quickly. I'm gonna pull the Band-Aid off really fast. Even though I got kind of furry hands and fingers or arms, every time I go in for an infusion, they're always trying to pull the tape back very slowly. And I'm like, yeah, just yank it. I'd just rather get the pain over with than suffer longer. So, but we will see where that goes. So, all righty. Take a look here. Market recap. S&P 500 rallies as investors pile into battered tech stocks ahead of Fed decision. It's written by Yassine Ibrahim from investing.com. The S&P 500 closed higher Tuesday as investors piled into beaten tech sectors ahead of the Federal Reserve's decision on Wednesday. Tech found its footing, climbing more than 3% as the recent weakness in big tech and chip stocks appeared to entice dip buying action. Apple and Microsoft led the gains in big tech, with both up more than 2% and 3% respectively, while NVIDIA and AMD also racked up gains. Also helping tech, Treasury yields took a breather somewhat from their recent melt up, just as the Fed kicked off its 2-day meeting. With the odds of the 25 basis point nearly fully priced in, investor attention will be focused on the Fed's summary of economic projections to gauge the shift in interest rate expectations for this year. Commentary on how committed the Fed is on tackling inflation will also be closely watched. If the central bank indicates that it favors a wait-and-see approach, that could stoke worries about whether the Fed is able to get inflation under control at a time when concerns about recession ahead continue to increase. I think the market will be, quote, I think the market will be disappointed if the Fed strikes a tone that we're going to raise rates by 25 basis points and then see how it goes. Dean Smith, or in quote, Dean Smith, chief strategist and portfolio manager at Folio Beyonds, said in an interview with investing.com on Tuesday. Sentiment on the broader market was also helped by easing concerns that higher for longer oil prices would dent global growth as WTI fell below $100 a barrel. Below energy, Baker Hughes, ExxonMobil were among the biggest decliners in the energy sector, which was the only sector in the red. The fall in oil prices wasn't stemmed by signs that an imminent diplomatic solution to end war appears to be some ways off after Russian President Vladimir Putin reportedly said that Kiev is not demonstrating a serious attitude towards finding mutually acceptable solutions, end quote. Industrials, meanwhile, were pushed higher by airline stocks after Southwest, United Airlines, and Delta reported stronger than expected bookings and signaled a quicker than expected recovery in travel demand. American Airlines and United Airlines are up more than 9%, while Delta Airlines was up more than 8%. In other news, Starbucks increased nearly 5% after it teamed up with Volvo Cars to explore the potential of installing electronic vehicle chargers throughout its stores nationwide. Big Lots jumped 15% after one of its investors, Mill Road, a private equity firm, urged the board to explore a sale in the range of $55 to $70 per share. The stock closed at $31.99 on Monday. So, like I said, kind of I look at this, from a standpoint as, it's kind of a bounce. I think a lot of people are probably buying the dips that we've been experiencing of late. Like I said yesterday, I would be very leery about, trying to time the dips or buy, investing too much into the dips simply because, you might be catching a falling knife on the way all the way to the floor. So, again, be careful out there. All right. Next article I got here, gasoline, food lift U.S. producer prices in February. It's written by Lucia Mutikani from Reuters. Let's go ahead and jump in. U.S. producer prices increased solidly in February as the cost of goods like gasoline surged, and further gains are in the pipeline following Russia's war against Ukraine, which made crude oil and other commodities more expensive. Well, I don't think the war made them more expensive. I think the inflation of the dollar really had more to do with that. The report from the Labor Department on Tuesday offered more evidence that inflation would remain uncomfortably high in the months ahead, despite underlying price pressures at the factory gate rising moderately last month. The Federal Reserve is expected to raise interest rates on, we already know this. With inflation running way above the U.S. Central Bank's 2% target, economists are forecasting as many as 7 rate hikes this year. Quote, we expect March PPI to show larger increases as commodity prices increase and global trade disruptions amplify, said Will Carpernell, a senior economist at FHN Financial in New York. Quote, for consumer prices to slow, firms will have to grapple with disruptions from the Russia invasion and new lockdowns in the heart of China's most productive regions, end quote. The producer price index for final demand increased 0.8% after accelerating 1.2% in January. Goods prices shot up 2.4%, the largest gain since December of 2009. After rising 1.5% in January, a 14.8 jump in wholesale gasoline prices accounted for nearly 40% of the increase in goods prices. Gasoline prices rose 3.3% in January. Food prices advanced 1.9% last month. Services were unchanged after increasing 1% in January. The PPI climbed 10% in the 12 months through February, matching the gain in January. Last month's increase in the PPI was in line with economists' expectations. The data does not capture the jump in prices of oil and other commodities like wheat following Russia's invasion of Ukraine on February 24th. Manufacturers reported a contraction in new orders and shipments, but continued to pay higher prices for inputs as well as charge more for their finished goods. Quote, geopolitical uncertainty likely bears much of the blame, said Adam Kamens, an economist at Moody's Analytics in Westchester, Pennsylvania. Quote, many firms are sitting tight either because their customers are doing so or in order to gauge the economic ramifications of the invasion, end quote. Despite the pullbacks in oil prices, inflation is likely to remain hot as a resurgence in COVID-19 infections in China, a major source of raw materials for U.S. factories, puts more pressure on supply chains. Inflation was already a problem before Russia's Ukraine war. Excluding the volatile food and energy and trade components, producer prices climbed 0.2% in February, the smallest gain since November of 2020. The so-called core PPI increased 0.8% in January. It was last month held back at 4.2% decline in portfolio management fees as investors dumped equities in favor of the dollar and U.S. Treasuries. There were also decreases in the prices of hotel and motel rooms, as well as apparel, jewelry, footwear, and accessories retailing. That offset a 1.9% rise in the cost of transportation and warehousing services. Airlines rebounded 3%, while healthcare costs rose moderately. In the 12 months through February, the core PPI increased 6.6% after gaining 6.8% in January. With the CPI and PPI data in hand, economists are estimating that, the core personal consumption expenditures price index rose 0.4% in February after gaining 0.5% in January. So we are seeing a little bit of a pullback in the core inflation. That would lead to an annual increase of 5.5% in core PCE price index, which advanced 5.2% on a year-on-year basis in January. It is one of the key inflation measures watched by Fed officials. This is consistent with the idea that underlying inflation is running at or about 5%, said Andrew Holenkorst, chief U.S. economist at Citigroup in New York. So again, it appears in some areas of the economy, inflation is sort of slowing down, but in other areas, it's still just as rampant as ever. So, my own personal view on it is that until we get interest rates above inflation, we're not really going to see, it might slow it down, but would you rather stop it in its tracks, or would you rather have it slide for, 6 months or a year and deal with it for a much longer period? So anyways. All righty. Last article I got here. Housing affordability is the worst it's ever been, analysts say. So let's go ahead and take a read through this, written by Rhonda Lee. Home buyers are facing the worst affordability conditions, according to two analysts who expect the housing market to get harder to break into this year. Quote, affordability from a home price down payment perspective is the worst it's ever been, meaning extreme barriers to entry, end quote, according to B of A global research note by B of A Securities U.S. economist Alexander Lin of B of God, that's a lot of words there. Still, quote, consumers remain steadfast in their interest to buy, but are uncertain, end quote, the analyst wrote. Three big themes emerged in the report. Higher mortgage rates are here to stay. It's still better to own than rent if you can afford the down payment. And supply chain problems continue to fuel constraints on inventory. Quote, the pickup in mortgage rates this year has been fast and furious, the analyst wrote, noting the 30-year fixed mortgage rate averaged 4.22% in March, up from the December average of 3.26. Citing Wall Street Journal data, quote, the massive rates move this year suggests that the affordability index will see another significant move lower, end quote. Higher rates will also hurt inventory because existing homeowners, which make up about 40% of the home sales, may be reluctant to sell because they feel the so-called lock-in effect. Quote, there's a greater disincentive to move and replace their current mortgagee that likely has a lower fixed rate, analysts wrote, lowering housing turnover. As home prices have skyrocketed, so have rents, analysts noted, which increased almost 15% year over year in January per Zillow. Given housing costs are rising broadly, the question many households face is which is less painful, to buy or to rent, end quote, the analyst wrote. By the slimmest of margins, it's better to buy than rent. And here's the major caveat. If you can afford the historically high down payment, the ratio is less than 1, suggesting it might be better to buy than rent. But this ratio does not account for property taxes or other expenses tied to home ownership. Homeowners spend $15,405 annually on top of their mortgage for costs associated with homeowners insurance, property taxes, maintenance and repairs, improvements, and utilities, according to research by Clever Real Estate. Nearly 2/3 of millennials who regretted their home purchases last year cited maintenance costs as the top factor, according to a study by Bankrate. The rent by calculation is also local. The analyst noted, for instance, renting in San Francisco or San Jose is the far lesser of two evils, with mortgage payment there taking up 45% of the median family income versus only above 25% for median rents. In Miami, it's flipped. It's still more affordable to buy relatively than to rent. Unfortunately, for Americans, there is no painless decision between buying or renting, the analyst wrote. Even before the Russia-Ukraine crisis, the housing market was constrained with supply chain issues. One of the biggest challenges in the housing market has been a dwindling supply, which has reached new record lows. Even before the pandemic, builders were constrained by finding new lots, labor, and lumber. The subsequent pandemic-related supply chain woes have only extended build times, and the Russia-Ukraine conflict threatens to add further hiccups, with material prices being pushed higher. Given the extraordinary supply challenges, we expect home prices to stay hot at a 10% clip in 2022, despite existing home sales pulling back. All right, so if you're planning on buying a new house in the next year or two, it may be, you may want to wait a little bit. I imagine that if we do go through some sort of recession, there's probably going to be a lot of inventory out there because you're going to have a lot of displaced Americans who are either going to have to sell or have their homes repossessed. So, it's unfortunate part of the market cycle, but you have to go through it at some point. So, all right, well, that's everything I had for today. I hope everyone has a wonderful evening. I'll be back tomorrow with Wednesday's Liberty Call. If anyone needs anything from me, don't hesitate to reach out. You can find me at dsafinancialgroup.com. All my contact info is there. If you want to book a meeting or you just want to send me an email, feel free to do so. Also, my email address is right here on the screen, so you can feel free to send me any information you'd like there or a topic if you'd like me to cover it. So, all right, well, that's everything I had now, and I'll see you guys tomorrow. Have a good evening. Bye-bye.